Hey, what's up everybody? It is Thursday, September 23rd. We had a big move up today in the markets, and first let me say this: if you're going to be in this business, you better be prepared for volatility. Markets move around, and you also better be prepared, and it's hard to be prepared for this thing that I'm going to say. You got to be prepared for official interventions, okay? So like, you know, I hear a lot of people talking about, oh, I wish there, you know, it's a free market and a free market this and a free market that, and you know, that's fairy tale talk, okay? That's fantasy talk. You know, we live in a society with an overarching political structure where it concerns markets. You have a central bank. You have a fiscal authority, which is Congress. Okay, that doesn't move day to day. It doesn't move necessarily without warning, because things go up for debate or whatever. You have large institutions that in some ways mimic monopolies, but mostly when it comes to short-term movements in the markets that are triggered by, you know, emotion or perception, that's usually tied to like a central bank action, all right? So yesterday, and I think I mentioned this in my video yesterday, we had, again, yesterday was a crazy day. First, the Fed's statement was, we're not going to do anything. We're going to keep buying 120 billion a month until if there's more progress, then we'll start to talk about reducing the asset purchases. So, you know, initially, and I said this reading the statement, it sounded like no taper. And then when Powell spoke, you know, there was a consensus that, hey, the Fed is now queuing up a taper. A taper is going to happen in November. So you had that whipsaw action. But that's, you know, again, that's why I say I don't pay any attention to these central bank meetings, because you get this noise, you get this whipsaw reaction, you get highly emotional markets, and I stay away from those. And I counsel people all the time to stay away from those. But there was one thing said yesterday, and I initially missed it, but I saw a tweet, somebody posted it up, and I think I did mention it on my video here yesterday, saying that the Fed was increasing the size that the counterparties in its reverse repo operations could post. In other words, it was 80 billion, the counterparty to those reverse repo. The counterparties are, you know, the banks or financial institutions that the Fed engages with when it comes to those reverse repos, right? The Fed will sell a treasury and take the cash, or in the case what the Fed is doing now with mostly with money market funds, because the banks are not really taking the deposits, they're shunting them off to money market funds. The Fed will take the cash from the money market funds and credit the money market funds with a what was it, a 0.05 5 basis points of interest. Okay, so that's the liability on the Fed's balance sheet. The asset is the cash that it's taken in, all right? And these are short-term operations. But the Fed increased that from 80 billion to 160 billion. Now, when I heard that yesterday, I mean, in the back of my head, a little light bulb went off and said, that could actually be bullish, because when they increase, they're doubling the size of the cash that these counterparties can post, okay, which constitutes what? A twice as big a reserve drain. And I'm thinking about that, and I'm like, you know what? Because I've been talking about these reserves, and that could be a bullish thing, but I ignored it, okay? For whatever reason, I ignored it. I was focused on the fiscal flows, which have been slowing down. And by the way, let me just state right here, coming in this morning, if you saw the economic data this morning, okay, we had a jump up in weekly unemployment claims. That would tend to corroborate what I'm seeing in the slowdown in the fiscal flows, what I've been talking about. We saw factory orders were weak, okay? Factory activity, I forget which survey that was, but it was, I think it was an ISM factory survey, and that was like at a 5-month low. And there was another, ISM services were also, I think they grew. It was a very small expansion, but it was the slowest in 14 months. So you had several items of economic data in there in the morning, really kind of, I think, corroborating what I've been seeing in the slowdown in the fiscal flows, right? I said the flows drive everything. If the flows slow down, you're going to see a slowdown in GDP growth, and the components of that growth, you know, all these other data and indicators, they're going to start to slow down. And I even said we could see a blip higher in the unemployment rate. And you got that blip up in weekly unemployment claims. Anyway, let me get back. So I said to myself, look, and I was conscious of the increase in the counterparties with respect to the reverse repos. Sorry, I was conscious of that this morning, but I said, look at that data. You know, that supports what I'm seeing in the fiscal flows. Anyway, we had this huge rally today. I mean, the market was, Dow was up over 600. I think it closed up over 500. We had a we had a drop in treasury bonds. We had yields were up at a 3-month high. So what's going on here? Then I looked at the Fed release, Thursday's Fed release, the H41, okay? Yesterday, as of yesterday, the week ending yesterday, saw a drop in reserves of 108 billion. That was the biggest single week decline in reserves in 3 months, okay? Reverse repos, outstanding, on the books of the Fed, 1.5, I believe it's 1.56 or 1.536. It's a record, all right? That was up like 188 billion in the week. So that's what happened. As soon as the Fed doubled the size of, you know, that counterparty arrangement, when it went from 80 billion to 160 billion, it was like swoosh, like a giant vacuum cleaner came in, sucking out these reserves onto the Fed's books. And what happened? You know, banks go in, they get freed up, their balance sheets gets you know, a little relief there. They come in, they start buying trading assets, they go up. Now, let me say, this situation now is bullish. I mean, it just flipped back to bullish, but underlying this, we still have the flows situation, which have slowed down noticeably. And again, I've been saying this, it's not like a collapse. It's still like very significant compared to where the flows were in the pre-pandemic, right? We were averaging 420 billion a month of government spending. We're going to come down somewhere around 600 billion a month. That's a lot. Okay, it's not 984 billion like it was in March. It's 600 billion. But 600 billion compared to, you know, the 420 billion pre-pandemic, that's a lot. And as far as bond yields, that reserve drain, I mean, that to me explains why yields popped up. I mean, you pull that cash out, there's less liquidity around to buy treasuries. You know, that makes a difference in the very short term, like, because these operations go on every single day. So the scenario really kind of has flipped to more of a bullish scenario, but I'm just still a little bit skeptical because the flows have been slowing down, and I think in the bigger time frame, and let me address this because people here are like, oh, you said it was going to go down and it went up today. You know, if you're coming here and looking for day trading advice, I mean, go somewhere else. I produce a macroeconomic outlook. The stuff that I talk about, the data I present, the rationale of everything I'm saying is a macro perspective, all right? If I'm saying the market's going down and it doesn't happen the next day and that doesn't work for you, well then go somewhere else, because that's not what I do, all right? Just wanted to put that out there because you got a lot of clowns here saying, oh, you said it was going to go down, that was up today. I don't do that, okay? I spent years and years and years on 4 different exchanges as a floor trader. Yeah, I know about short-term trading. I know about micro short-term trading. I did thousands of trades in a day when I was a floor trader. I don't do that anymore, all right? This is macroeconomic analysis. Anyway, that's it for today. Let me see what happens tomorrow. I'm tracking these flows, but what the Fed is doing, and I have to say, they're managing this situation pretty adeptly, I have to say. They're also, I think, starting to push rates up on themselves, but that would justify, they're already talking about a rate increase in 2022. So I think that justifies, what they're looking to do. So that's it for today. Let's check out what happens tomorrow, and I'll be back at you. Take care. Bye-bye.